Everyone, and welcome back to Southern Wealth. I hope you guys are doing very well. If you do enjoy the content, please consider dropping that like and subscribe. It greatly helps the channel, so thank you very much for your support. So, another week is over. This week I have a little bit of a personal update. You guys recall that I've been working extremely hard this year with expectations of being promoted, and it seems that there's a good chance that that's going to happen this year. So I'm very happy with it. And as you guys know, I may be wrong on certain things. I may miss certain things, but I always arrange my life in which myself and my loved ones are always in a very comfortable position. Even if I make mistakes, even if I don't make mistakes, doesn't really make a difference. I'm always on top of that, and I'm very happy with it. So let's see how it goes. It's nothing concrete at the moment, but seems very good. Seems it's going in a very good direction. Let me put it that way. So let's go to the things that you actually care about, which is not my life. It's about markets, etc. And what am I seeing? So I'm seeing things that I really like seeing. So we've discussed this 1,000 times in the past, but it's a good thing to refresh the memory, and also for the new people. I've been getting a lot of new people, and my subscribers count has been doing very, very well, so thank you for that. It seems that you are indeed pressing that like and subscribe, as I always ask. And as I've mentioned 1,000 times before, let's do the 1,001 time. Fundamentals precede price, and then price precedes narrative. So the fundamentals in place, which are very positive at the moment, are yields. Particularly long-term yields are dropping like a stone. It seems that finally we have a breakout in bonds, the long-term bonds. Now, am I invested in bonds? No. Do I like bonds? No. But the bond market is the key, is the pristine collateral for all the other markets, is what makes the other markets function. Without a functioning bond market, you don't have a stock, a commodity, or a crypto market, period. So that's why I look at it. Very important. Yields coming down, very important. Dollar in the low 98, also good. I would like to see it start moving to the levels of 94, 95. That would be great. And oil is around mid 50s, which is very, very good. So you like that oil price cheap as well. Those are all easing of financial conditions. The financial conditions is liquidity flows in, asset prices react, boom afterwards is exactly what you need. Very much low oil prices, inflation comes down, more rate cuts, blah, blah, blah. You know the drill. Okay, so what is the big talk in the town now? The big talk in the town is the short end of the yield curve is going higher. That means think about the yields on the 6 months, 3 months, 2 years, 5 years, etc., instead of the 10, 17 year or 10 and 7, 10, 20 and 30 years. So those are all coming down, and the short end is going up. Oh my God, this is going to be terrible, particularly for regional banks. This is going to go to zero. This is terrible. Financial crisis 2.0. And here we go. Everything's going to zero. That's why gold is going up. So that's the story. That's the narrative. Now let's play out that narrative. Let's say that regional banks are indeed collapsing. Do we know what's going to happen? Yes. March 2023, we had a couple of big regional banks collapsing. And at that time, inflation was 5%. Not 2.7 like now, 5%. March 2023. What did the Fed do? Injected $800 billion, reversed 80% of the quantitative tightening during that month. Crisis averted, liquidity flew through the system. After a few months, we were at all new all-time highs. Everybody panicked in March 2023. Everybody called it the second financial crisis. Everybody called it the collapse. And I came here and I said, Guys, you have to understand something. Financial crisis 2008, it took the Fed and the government more than a year to agree in printing $1 trillion. $1 trillion, more than a year of discussion. 2023, the regional banks go bankrupt. It took them a weekend to get 800 billion, which is 80% of $1 trillion, when inflation CPI was 5%. And what happened afterwards? Because you know that what drives the market. If you give enough period of time, what happens to the market? Liquidity is what matters. So liquidity got injected. After a while, there was no financial crisis, and asset prices went up, and that was it. So you already know. So the first time, let's say the first time that this happened, that there was some weakness in regional banks and there were some strange behaviors in the yield curve, etc., we saw what happened. Two banks went bankrupt. The Fed stepped in immediately, couldn't give zero craps about inflation, injected and stabilized the market. And after a few months, we were at new all-time highs. This time, we are not even in that stage. But if we get there, you already saw the blueprint of what's going to happen. Oh, but this time it can be worse. Okay, instead of 800 billion, they will print 2 trillion. It doesn't matter. They don't give a crap. Now, notice that I'm not saying that it's good or bad. I'm not making a value judgment. I am telling you that eventually, if we get to that point, which is unclear that we're going to get to that point, but let's say we do it. Let's say we're getting to that point. You know what's the playbook. There's no doubt in my mind. Now, I understand, because we've been talking about this even throughout the summer in August. We've been talking about this. I said, don't be surprised if we have a correction late September, first half, or mid-October. It's fine. We can have corrections around that time period. And particularly because what have we been doing since April? Nothing but up. So anything that disrupts the perfection that the market was priced in for, anything that disturbs that, you will have sharp short-term corrections. We'll let people guess and punish anyone that behaves or that moves too harshly. Now, in terms of the crypto market, if I could have my way, I'm not sure if I'm going to have it. Most likely I won't. There is a big gap, CME gap, between 92 and 95K. If I could have my way, I would love a big, fast sell-off that would push the price into the 92, 95K, get rid of all the 4-year maxes, get them all out, and then moving up from there. That would be my preferred, if I could pick, if you ask me, Southernwell, pick your dream scenario, your fantasy scenario, that would be it. A big sharp sell-off, ripped band-aid kind of sell-off. We push it to the 92 to 95K. We close that gap. All the 4-year cyclers are all selling right there. And then we move straight up from there and we force them to buy higher later. That would be my preferred scenario. Will we get there? Probably not. If I had to guess, probably not. But I would like to see it. One of the good things that I've seen is that the Fear and Green Index is at 28. Very good. That's and I get the feeling that we're going to go somewhere to 25, 24 tonight, which means we are approaching extreme fear. So we are closer to extreme fear than to neutral, if you can believe that. And I like it because I've never seen a bull market end in fear or extreme fear. You see the last time that we were at extreme fear was in March of this year. And I invite you to see what happened to the price ever since we got there. Pretty much doubled, almost doubled, from the bottom of that extreme fear sentiment. We've been seeing pretty much this cycle, what you've been seeing in crypto has been, for the most part, institutional money and companies. You've seen very little retail, which is good. That means that they can come later, and that also the big players can also come later because they need some more assurance, particularly the banks. In order for banks to really engage on a serious mainstream fashion with crypto, they need some of like the Clarity Act to pass and all of that stuff, which is positive catalysts for the future, which is also very, very good. Now, when it comes to gold, and I've seen these articles everywhere, gold is going up because the dollar is about to collapse. Gold is going up because a financial crisis is about to erupt. Gold is going up. There are physical lines in Australia of people buying gold, all of this kind of stuff. And I invite you, whenever you see news like that, because this is very important, I invite you to Google what happened in 2011. Because 2011 was also a blow off top for gold, and the same behaviors, the same narratives, all played out exactly the same. However, 2011 has been a long time ago, so people completely forgot. So it's good when you see certain things on Twitter about people doing this, people doing that, etc. You should have a look at what happened in the last big blow off top of the bull market in gold, and see the narratives. And by the way, 2008 made a lot more sense for gold to blow up. I'll tell you why. You had the worst crisis since the Great Depression. You had the Dixie, the dollar index, was at 70. It's now 98, and everybody's losing their mind. It used to be at 70 during that time. Oil prices, 2008 was $150 a barrel. It's now 58, 56. People forget, people have no idea. And then we come out of the financial crisis, and which started and happened in the US, and by 2011 we have the European sovereign debt crisis. So if you think it from a narrative perspective, you see these are the two big currencies on the planet, the dollar and the euro, and both are having crisis. You have to go back to the Great Depression to see something like this. Now it's the time for gold to shine. What happened? Gold has a blow-off top in 2011, drops 50% until 2015, and then by 2021, if I'm not mistaken, it finally makes a nominal, keyword nominal, all-time high after 10 years of suffering. Why do I say nominal? Because you have to understand something. What have we been talking about? Your investments have to outpace the debasement of currency and the CPI. Debasement of currency is global M2 goes up on average 8 to 10% per year, and the CPI goes up, call it 3% per year. So you need 8 plus 3, 11 to 13% just to break even from the devaluing of your currency. Break even, not make money. Break even. Very important. So I ask you, what would be the gold price? What would be the break-even gold price versus 2011 adjusted for money supply and CPI? The answer is $6,500. Versus 1980, it would be $55,000. And every year we don't get there, it accumulates one more. So in order for gold to just break even versus 2011, we need to go to 6,500. Now, there's been a huge retail pileup of gold in these past weeks. That's why you've seen this vertical move, this blow off top. And one thing that you have to understand is this. Bull markets, 24x, 1970 to 1980, 24x, gold peaked. Bear market for 20 years, up until 2000. 2000 we get to $250, we go to $1,900. That's a little bit like a 9x. 10 years. Bear market, 50%, 2015. 2015 to 2025, 4x. 10 years. Keep that in mind. That's all I'm going to say. Am I predicting the top on the day of gold? No, I'm not trying to do that. I'm just saying, understand when the move may look overextended or not. Maybe it's going to $30,000. Maybe it's going to $100,000. Maybe it's going to go to $1 million. Possible. What I'm saying, because nobody will tell you this, is understand the previous bull markets in gold. Understand that the narratives, but this time is different because the dollar is about to, and the enemies of the US are about to, and the blah, 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 blah. All those narratives, they are not new. They happened in 2011. But people forgot because it's been a long time ago. When people saying, everybody is dumping treasuries because people want to get away from the US, the last month that we have data, foreign holdings of US treasuries hit a new all-time high. Again, narrative is Trump is a bully, he's attacking friends and foes, they are all dropping US treasuries. That's it. The dollar is finished. Reality, foreign holdings of US treasuries hit a new all-time high. Everybody's selling the US stocks to buy the European stocks and the Asian stocks. Foreign holdings of US stocks hit a new all-time high again this month, the past month. Story, reality. Important to understand the difference. Another one. Gold is going up a lot this year, 2025. Gold is exploding because foreign central banks are buying a bunch of it. Wrong. 2022, foreign central banks bought more than 1,000 tons. It was a world record. 2023, more than 1,000 tons. 2024, more than 1,000 tons. 2025, we only have first half data, 415. Annualized, that's 830. That's a 20% decline from the Biden administration to the Trump administration. Again, narrative, foreign central banks are buying gold to escape the dollar. Story, sounds nice. Reality, there's a 20% decline on an annualized basis from the Biden years in terms of foreign banks purchasing gold than today. Very important. Another one. Let's go with the narratives. China is dumping US treasuries. It has the lowest holdings of US treasuries because of Trump. That's the story. Reality. Trump first term. China held $1.1 trillion January 2017 when Trump came into office. Trump left office January 2021. China held $1.1 trillion. Biden came in, $1.1 trillion. Biden went out, $760 billion, a 30% decline on the China holdings of US treasuries between Biden getting elected, Biden leaving. That's on average 7.5% decline per year. What have we seen in the first half of 2025? A 3.5% decline. If you annualize it, is 7% decline. Actually, a little bit less than Biden. Why did China start doing that? I tell you, because the US froze Russian assets. And then the Chinese saw, if we do something they don't like, they will do the same to us. So they start dumping at record pace when Biden was president. Narrative, Trump is very mean to China, so China is going to dump treasuries to collapse the US. That's the story. Reality, this aggressive selling of bonds started with Biden as president after the US freezes Russian assets. Narrative, reality. Very important. So that's why you come here, because, by the way, all that I've just said is public, factual data. There's no story. Now, what people say is, the foreign reserves in gold are now surpassing the treasuries. Price in dollars, not tons, because gold is supposed to be an alternative to the dollar. So you should think about it not in dollars, you should think about it in quantities of gold that you have. And the reality is that the central banks are slowing their accumulation of gold versus when Biden was president. So so you should look at tons, not the dollar price, because tons is what matters. So, in summary, a lot of confusion, a lot of craziness, a lot of fear in certain markets, a lot of euphoria in other markets. Resuscitation of former narratives that were lost since 2011. You had to go back to those time periods to find something like this. In summary, is liquidity going up? Yes. Will it accelerate? Most likely. Is the business cycle peaking? Not even close. Am I worried as long as this situation stays like this? No. There's a lot of headwinds coming, particularly on the deregulation front, and also on the effects of the tax cuts that should be very positive, as well as progressive lowering of rates that should be very helpful on all these matters. As you guys know, I'm a bit of a cookie. I like the red candles. I like the max pain. That's when you get the best deals. Very tough to deal with, but then when you look past, oh my God, I have such a good average price compared to all the others. Yeah, that's right. It's much easier to buy the big fat green candle than the red candle. And with that, thank you very much for your support, guys. Don't forget, like and subscribe. And I'll catch you in the next one.